Following our video on the 8th of May, one of our Facebook followers, Joseph Chia, sent us a series of really thought-provoking questions and comments, which we reckon deserves a thoughtful answer. The central question from Joseph is, does MMT, or modern monetary theory, set a new normal? And how will this affect the stock market?
You know, that's a really great question. Since that video of the 8th of May, the S&P 500 picked up another 10%. In total, the index had gone up 48% from its April low to its recent high. And all that in a world where economies are contracting at rates not seen since the Great Depression, where COVID-19 has infected 7.8 million people around the world, killed close to 500,000, and is adding another 140,000 new cases per day.
So, what is the market celebrating?
Now, this is where Joseph's point about modern monetary theory becomes interesting. MMT is about central banks printing money out of thin air to finance governments spending money they don't have. That is, when central banks are no longer independent of the government. We haven't quite reached that point yet, but nevertheless, traders out there have been celebrating the printing of money, massive amounts of new money. The Federal Reserve, for example, has expanded its balance sheet by over 70%, that is 70% since the start of the year. And markets are celebrating because a lot of that money is going into the markets to buy government and corporate debt securities.
But what does that have to do with the stock markets?
Well, not directly, because the Federal Reserve is not buying stocks yet. Maybe traders are hoping they will buy stocks eventually, but it may never happen. More immediately, the thinking in the market goes like this. If the Federal Reserve buys a whole lot of debt, that will price these debt securities upwards, forcing yields to come down. And by extension, that forces down the relative yields expected from stocks and hence forces up stock prices, if you follow what I'm saying.
So it does work.
Yeah, only for a while. Only if markets can go on ignoring three things. One, that corporate earnings are going down. Analysts estimate 43% decline in the S&P 500's earnings in the second quarter. And it can get a lot worse than what these analysts are expecting for the rest of the year. So that's not even the worst of it. Indeed, during the global financial crisis of 2008, the S&P 500's earnings for the full year was 40% lower than the previous year. The second thing, governments everywhere have taken on massive amounts of debt during the pandemic, and debt eventually drags down future economic growth. Third thing is that if central banks and governments do eventually engage in this modern monetary theory, currency markets will likely abandon the currencies of those countries that engage in this, causing currency devaluations, rising inflation, and higher interest rates. And that can't be good for stocks either.
What's next for stock markets?
Well, we refuse to chase after the bull because that won't end well. On Thursday, the 11th of June, we saw the S&P 500 fall nearly 6% in just one night, one session. And that was a reminder that this isn't over yet. It is true, though, that central bank interventions have stabilized the financial system, prevented an economic crisis morphing into financial crisis. But there will be more bouts of fear ahead because markets can't forever ignore falling economies, falling earnings, and the damage caused by excessive government spending, debts, and monetary expansion. There will be buying opportunities at lower levels. Right now, let the market rebalance to more sensible levels.